So today our group will have a presentation about the Great Depression and the Great Crisis. First of all, we want to give some background information about two kinds of crises. The crisis, both crises, they happen mostly in America, the US. So the first of all, we will talk about the euphoric bubble, or we might call it American Dream. In 1920s, the Wall Street in America, the prosperity widespread in a certain for a decade. This means from 1920 to 1929, the GDP, the economy is very strong, and it seems that it's become a new era, the jazz era, new age, and everybody tend to buy stock, even normal households, and then no risk calculation. Even the expert cannot calculate the risk of the market because everybody was too confident. And in 2007, the housing market in the US, even in the worldwide investor, it means a bigger scale. The people want to build real fast, so everybody want to own a speed of real estate. Therefore, they buy the market without hesitation. And therefore, the bank will give the market without consider about how the people will pay back the loan. In 1920, the stock speculation become a part of life in the US. It means everybody in every household will talk about the stock, how to buy the stock, when, and it's become a part of the culture. The stock moved to the center of the culture in the US. And in 2000, the real estate speculation in the housing market of the US, and moreover in the Dubai, in the Iceland, and some financial speculation in England. And I think that is the background of the crisis.
As for the causes of the crisis, it is no doubt that the stock market crash is one of the causes. Comparing two stock crashes, as for the causes, they share the same causes. Falling real estate prices and the vastly overvalued stock were the common causes of both crashes. We can see that the US government did not learn from the Great Depression and let the same factors lead to another crash. Alongside causes, another similarity is that somebody wanted to save the market and stop the crash by injecting money. In 1929, William Durant, the founder of General Motors, kept pumping his wealth into the market so as to save it and make the public be confident to the market again. He ended with losing all his fortune. Similar thing was done by the US government in 2008. The $700 billion bailout was similar to the act of William Durant. It also tried to save the economy and gain public confidence. Yes, and this is the similarity and comparison between two stock crashes.
Yes.
We talked about the collapse of banking system from both crises, and first of all, I'll talk about the collapse of banking system during the Great Depression. Mostly, first, during the 1920s, just like we have mentioned in the background, like people in the United States is fascinated in stock market, and the market is doing well, and so people start to borrow money from the banks in order to invest in the stock market. At first, everything seems to be on track until the stock market crashed in 1929. Tons of people failed to repay the loans since they had lost all their money in the stock market. The defaults had then caused some local banking system and commercial firms to fail, which then has shaken the confidence of depositors in the banks, creating the banking panic. And so, the banking panic is basically that where people rush to withdraw their money from banks, and since the banks have only had a fraction of the value of their customer deposit in the form of reserves, A sudden, unexpected attempt to convert deposit into cash leaves the banks fall short of reserve, then causing more banks to fail, including some large banks, which eventually caused the collapse of banking system during the Great Depression. And now, here's some statistic that shows the numbers of banks during before and after Great Depression. As we can see from the chart, before the Great Depression happens, there were 25,000 banks in the U.S. in total, and by the end of 1933, over here, around 11,000 banks had failed, as we can see from the graph, and the numbers of banks dropped sharply after 1931. And then now I'll go through the financial crisis, the collapse of banking system during the financial crisis in 2008. And the main cause, as we know, is the flood of MBS and CDOs, and also the irresponsible subprime mortgage, where the subprime mortgage are offered to potential home buyer with questionable or no credit. And the overall effect is that the world's surplus cash start to flood into the U.S. the housing market, and then creating the well-known American housing bubble. And then eventually the housing bubble burst. And this caused around 488 financial institutions, including investment banks, commercial banks, and all the saving and loan association, to declare either bankruptcy or insolvency from 2008 to 2012. Over 65 banks has been taken over by the Federal Deposit Insurance Corporation, which is the FDIC, since the beginning of 2008. And the government, the U.S. government in total, according to calculation, the government has committed approximately 12.2 trillion and spent actually 2.5 trillion in all sorts of bailout projects. So that's a real large number compared, yeah. And now, the leaders from the globe start to think. So what's this similarity and differences between these two collapse of systems? Is that first, the similarities both results from the overheating economy, where all the hot money and investment is flooding into the U.S. which eventually causing all the chain effect of the financial crisis, and both send up shockwaves to the world. And as you can see from these three charts above, which showing the comparison of the effect on the world's output, stock market, value of trade after the Great Depression and the credit crisis. And the red line represent the credit crisis, and the blue line represent the effect after the Great Depression. As we can see, all of them is downward sloping. So eventually, the difference is that the collapse of the banking system in credit crisis is mainly results from the financial institution itself. But for the collapse of banking system during the Great Depression, it's mostly all sorts of.
Now I'm going to talk about the other cause, protectionism. When we talk about protectionism, we must talk about the Smoot-Hawley Tariff Act, since it was the trigger of the protectionism phenomenon. The act was proposed in 1928 and passed by the U.S. Congress in 1930. The aim of this act is to help the U.S. farmer by reducing food import. The act has already been affecting the U.S. even before it was passed. It is considered to be the partial cause to the market crash in 1929 and 1930. For example, 2 weeks before Hoover signed the act, the Dow Jones Industrial Average had fell for 23%. On the day that Hoover approved the act, stocks lost $1 billion in value, which is a huge amount back then. After passing the act, the effect on the US became more prominent. The US import had dropped 66% from 1929 to 1933. At the same time, it triggered retaliation and protectionism from 60 countries. These countries has also imposed tariff on the importing goods. Not only did this decline the world trade, the US export has also dropped by 61%, which worsened the US economy. This decrease in the export has triggered waves of bank runs and closures. As the US agricultural export declined, many farmers defaulted their loans. As there are a lot of farming activities in the Midwest, thousands of banks were affected there. Mineral sectors affect banks in Nevada, and at the center of the automobile industry, Detroit had a chain of bank closures happening. Compared with today's credit crisis, we can see that the government's attitude towards protectionism is completely different. Nowadays, people invest globally. The US government will not interfere with the foreign import or liquidity entering the US market. However, it is this open market policy that caused too much liquidity and support the formation of the housing bubble. Now I'm going to talk about what happened during the crisis, focusing on the government's response to the crisis. As both crises happened in the US, the comparison will be about the US government's policy. First of all, for the short-term recovery measure, there is the change in the money supply. In the 2008 crisis, the Fed has increased the money supply by expanding the size of the Fed's balance sheet, lowering the interest rate. The Fed had also lent money to some financial institutes. These actions had improved the situation, as it helps avoid a deflationary spiral, in which the price of the goods, the production, the wage, and even the employment rate would drop. For the US government in the 20s, they had decreased the money supply by 1/3. This had worsened the situation as people had started to save more money and consume less. This then caused the employment rate, production to decrease, and the price to drop. Another kind of short-term recovery is the stimulus policies. In the credit crisis, there is the Economic Stimulus Act of 2008 by George W. Bush and the American Recovery Reinvestment Act of 2009 by Obama. While during the Great Depression, President Hoover had done little to stimulate the economy except lending to banks, so that they can hire back their employees. Hoover believed that the economy can fix itself, therefore government should avoid interfering in it. At the same time, the government should even cut spending during the hard time. For the next president, Franklin D. Roosevelt, he implemented the New Deal. For the stimulus policy, there are three major common aspects. There are the tax, employment, and the subsidies for the underprivileged. For the tax, in the 2008 crisis, Bush had the income tax rebate. Most people received $300. Studies had compared the spending patterns between the families who had received the rebate with those who had not yet received it. It is found that the rebate had increased the spending by 3.5%. For Obama, he had the tax cut. The tax is cut by $400 and $800 for individuals and families respectively. These measures had improved the situation. However, the effect is insignificant. Some people also believe that the tax cut now means tax raise later on. Therefore, instead of spending, they had saved the cash. For the Great Depression, the government had raised tax. Hoover increased the top individual tax from 25% to 63%, and the corporate tax from 12% to 13.75%, while Roosevelt had raised the top individual tax up to 79%. These policies had worsened the situation as it reduced the work incentive and discouraged investment and consumption of the general public. For the employment aspect, in the credit crisis, the American Recovery Reinvestment Act of 2009 had helped small business because they are responsible to creating 70% of the new jobs. The US government had supported this business by tax cut and increasing the loan limit to them. At the same time, infrastructural projects were implemented to create job opportunities. These policies had improved the situation, though not very effectively. The unemployment rose despite these measures, as the recession was very serious. The job created was about 2 million. However, studies had shown that only 23% of the small companies had kept the hired employees after the policies ended. As for the governments in the 20s, they had tried to protect the interests of small business and the workers. They had encouraged the market to avoid cutthroat competition and passed the new minimum wage. However, these measures had worsened the situation as the government promoted less competition in the market. Consumers found products less attractive without a price drop. Thus, consumption reduced. As a result, business suffered and employees were laid off and the unemployment rate rose. On the other hand, infrastructural projects were conducted, such as the TVA and WPA. They had provided a lot of construction jobs. This has improved the situation, and the WPA solely had provided 8 million highway jobs. For the subsidies for the underprivileged expert, in the credit crisis, besides creating jobs for the unemployment through the infrastructural project, the government had increased the weekly unemployment benefits, providing funding to the disabled, supporting food banks and the education of the homeless children, and many other policies. As for the government during the Great Depression, they had also created jobs through the construction of infrastructure. They had also created the 30-year mortgage so that more families can afford house. Furthermore, the Social Security Act was passed as an unemployment insurance and also provide welfare for the disabled. Other kind of short-term response is bailing out of banks. In 2008, there is the Troubled Asset Relief Program, in which the Fed purchased mortgage-related assets, bailing out the too big to fail companies such as Goldman Sachs and Morgan Stanley. The Fed had also taken over 25 banks. In the 20s, the scale of the government's bailout program was in a much smaller scale. What the government had done is to provide loans to the failing banks and expect them to hire back the bank employees to prevent further worsening the unemployment problem. Finally, for the long-term measure, both governments had imposed greater restriction on the financial institute. In 2008, the Dodd-Frank Wall Street and Consumer Protection Act, in which councils were established for monitoring the activities of financial institutes. The councils were also given the rights to break down the too big to fail companies if necessary. The bank's lending procedure has also been revised. For the rating agency, their rating accuracy would be monitored as well. In the Great Depression, the New Deal had aimed to reform the financial system. FDIC were established to protect the general public's deposit account. At the same time, the SEC were established to regulate the market's activity.
Okay, finally, let's compare different consequences of two crises. I will mainly talk about the US, China, and the European Union. The thing that before the Great Depression, there's no EU existed at all. So I will suggest two representatives of the EU members, Germany and Spain, to show something interesting. Notwithstanding a host of the vaccine medium and the long-term challenges, the US faces a less daunting situation in the near term. The status of the US dollar as a global reserves currency, the comparative flexibilities of the US workforce and its traditionally high level of productivity, the fact that US population supplemented by the immigrations doesn't face the negative demographic trends, the strength of the US military and the steady increase in corporate profits during the past 2 years, which has resulted in US business holding significant cash stockpiles, which while some companies are returning the cash to the shareholders. Recent data indicate that the business has never begun to invest at least a portion of this cash in the productive areas, which is contributing to economic and employment growth. Moreover, significant cash stockpiles give U.S. business some flexibility. However, economic recovery in the U.S. is likely to remain slow and uneven because it appears unlikely to be consumer-driven in a meaningful way. given the contributing high levels of the consumer indebtedness and unemployment. They are just like two flashy strings holding the whole U.S. tightly. In the United States, consumers' spending accounts for about 70% of the economic activity and therefore must play the critical roles in the economic recovery. However, notwithstanding the recent uptick, real consumer spending has grown at only the modest pace since recovering from the deadlines in 2008 and the first half of 2009. And as shown in the exhibit, one reason behind the weakness in consumer spending is the dramatic increase in the personal savings rate that followed the 2008 crisis. Amidst stagnant growth in the disposable incomes, it is worth noting that, moreover, the recent increase in consumer spending has resulted in the large apart from the slight declines in the savings rate, not because of the growth in commerce or employment. These indicate that any further increases in consumption and the U.S. economic growth is likely to be modest, at least until employment increases meaningfully. Unfortunately, a number of the factors indicate that U.S. unemployment will probably remain stubbornly high in the near term, despite recent signs of improvement. In contrast, the aftermath of the Great Depression seems much more serious. By 1936, all the main economic indicators had regained the levels of the late 1920s, except for the unemployment, which remained high. By 1939, the effects of the 1937 recessions had disappeared. Employment in the private sectors recovered to the level of 1936 and continued to increase until the wars came and manufacturing employment leaped from 11 million in 1940 to 18 million in 1943. The government began to have a military spending in 1940 and started drafting millions of young men that year. By 1945, the 70 million had entered service to build the country, but that was not enough to absorb all the unemployed.